Welcome back, my two favorite subscribers. Today I'm going to be doing the second part of the liquidity series that I started last week. Today I'm going to be showing you some actual charts, some entries, and how to look at the market and spot liquidity on the charts overall. I didn't prepare much for this video, to be honest, because there's not so many people watching it at all. If you're here by any chance, I promise you that you're going to gain some knowledge from here, so please pay attention to what I'm doing. As you can obviously see, there is a downtrend on the silver, so we were on a downtrend for a while, and we came here and we put this low. Now I put an arrow here which is pointing that at this point we took some liquidity on the left side, and now as soon as liquidity of the swing high and swing low is taken, you have to look for the reaction. As you can see here, we failed to close below this low. Now I have to be super specific about this. Even if we had a closure here, like I said in my previous video, there can be times when there is a closure. We do not trade breakout trades. Why? Because the next candle can open and shoot back to the range. So it's not about having a closure or not having a closure, it's about market reacting after breaking a swing high and swing low, because you have to understand that at every swing high and every swing low there is liquidity. We don't look at it as a market structure shift and break of structure, we look at it as a liquidity sweep. So we swept the liquidity and now we have to look and see what's going to happen now, right? This is called market auction theory. So we have to see if the market is accepting the lower prices or higher prices or not. In this scenario right here, we can obviously see that market is not accepting the lower prices. We went down, we swept the liquidity below. So this is gonna be here, liquidity sweep. How many is liquidity sweep? Right, what the fuck, I guess, well, doesn't matter. We swept the liquidity. After that, we look for the reaction. We shoot back straight to the range, right? So for us, shorts are not possible here anymore. Now we actually might look for longs. And then we go back to the range and we start pushing up. For me, still there is no place for entry at all. Now look at this. We came up, we took this high here. Again, swing high. After the swing high is taken, we look for the reaction. Here, market is not accepting higher prices. We go back to the range. After we go back to the range, what we start doing? We started consolidating sideways, making this trend line. If you watched my previous video, I said that one of the most common patterns for liquidity sweep is going to be trend line. So the market was ranging, making this trend line here. When you have a trend line, so you have people entering sells here, putting their stop losses here, entering sells here, putting their stop losses here. What happens here? Market breaks the trend line. Here, there were people who entered sell, like they did here and like they did here. Now these people are fucked because their stop losses are here and they're gonna be taken. So they are stopped. Not only the sellers are stopped, but the buyers are induced now, because as you can see, we had a trend line, we broke it. Now the breakout traders are going to think like, oh, we're going up now. They're going to open the long here. They're going to put their stop loss somewhere here or whatever. Depends on how stupid they are. And then the market is going to go back to the range again. Now if you look here, we swept this low here. That's what gave a fuel for this push up. Because as I said in my last video, liquidity is a fuel for the move, for a price move. As you put a fuel in a car when you go for a trip, the same way that market needs liquidity to move. So after the sweep of this liquidity, we got a fuel to move up. And then what happens? After this, we fail to close above. We shoot back down. We sweep this low. Now again, look for the reaction after the liquidity sweep happened. And this is actually a perfect example, because as I said here, we had a candle close. And what happened? The next candle shoot back to the range. So if you were trading candle close and you were like, oh, we have a candle close, now I can open the short position, you're gonna be stopped again because the next candle was bullish. So you have to wait and look for the reaction. After this, we start going up, consolidation, boom. Again, after we swept this high, what happens here? Shoot back to the range. Now look at this. Every single time, as I said, the market wants to make a move, it needs fuel. So if you're trading market structure, look at this. Lower high, lower low. So now if you're trading market structure, you're gonna be induced here to sell, because for you, this is market structure shift or break of structure, change the state of delivery, I don't know how you guys wanna call it. Now, you are trapped here, you're opening the sell position, right? What the market does, it induces sellers and then it shoots the opposite way. Look at this. If I put the sessions here, it's gonna be New York session. So we go down, we sweep the London low, as I said in the previous video, sessions low, session highs is also very important levels of liquidity. We sweep like London low, we sweep this internal level of liquidity and we push to the opposite side. Boom, this is a perfect trade here for you. After that, what happens? We go back to the range. Now look what happened meanwhile. We had this low here and this low here. If you're trading trend line, again, boom, you're gonna pull this trend line and then we came back down, took all these lows, like all this internal low, this low, this low, this low, all these lows are taken. And we go below the trend line. Now again, if you're trading trend lines, buyers are buying here, putting stop losses here, boom, they're taken. If you are selling the trend line breakout, you're gonna be selling here, your stop loss is gonna be here, and then you're gonna be tricked as well. And this is actually where I took my trade, because I saw that we broke the trend line. I waited to see, not a candle closure as I said, because we had a candle closure. We had two candle closures or whatever. I waited to see if the market is accepting the lower prices. Market didn't accept the lower prices. It went back to the range and it gave me change in a state of delivery or market structure shift, whatever. And I opened trade here. And to be honest, I don't remember where I exit. I was showing this trade in the last video actually, I think. I exit somewhere here before the liquidity block here. Okay, so after that we pushed up, blah, 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 blah. Look at this. Every single time the market wants to make a move, it swipes the internal low. Boom. Swipe, sellers are induced, market pushes up in the other way. Boom, boom. Then we continue higher. Look at this. Market wants to go up, sellers are induced to sell, boom, market pushes the other way. Like I can show you 10,000 examples. That's why I didn't even prepare for this video, because there is so many examples you can see on any chart. Like for example, let's go to gold. Okay, cool. Here, exactly same example, literally. Trend line again. Boom, 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 boom. What happens? Break the trend line, sellers induced, buyers stopped, boom, we pushed in the other direction. Here, previous day high, important liquidity. What happened? We took a previous day high. Look at this price action here, please. We took a high, we closed above. Now you wait for the reaction. You see this? This means that market is accepting the higher prices, because in previous example we pushed up, boom, we pushed back to the range. If you see this, we closed above, we started consolidating here, boom, boom, boom. This is a positive reaction for you, and this is when you can take a breakout trade, because you can obviously see that market was accepting higher prices above the previous level of liquidity. And then you're gonna wait for whatever setup you wanna use. You can use this breakout here, long here, boom, you're gonna put your stop loss here, and then you're gonna aim for whatever level of liquidity you were looking for. I pull here this order block from the left side, and this could be a trade for you. Again, look at this, like, I swear, any chart at any time, look, low, swept, push higher, here, swing high, swept, buyers induced, stop losses here, whatever, market goes the opposite direction. Like, I used to trade market structure. That's why I'm like, when I started learning about liquidity, this changed my trading completely. Because if I was trading this before, you have boom, you have high, higher low, lower high, lower low. Bro, for me this is short. But what market did? It swept this low here, boom, it pushed up. Then here I'm like, oh, okay, cool, so we're not going low, we're going high. What it did, it swept this high, and then now we're going lower. Like, it's as simple as that. What did I say last time as well? Okay, yeah, sessions. If I put on the sessions here, you can see, for example, we are on a downtrend here or whatever. Asia makes this low. Look how London swipes the Asia low before it pushes up. Look, it took the Asia low, bam, pushing up. If you want to use this indicator, by the way, it's called Lux Algo. I think it's the best indicator for sessions because it's very clean. It gives you these boxes. Look at here, bam, again, Asia low swept, push higher, then dumped. Okay, cool. I was talking about equal high and equal low. Let me try if I can find any. Boom, there you go. Equal highs here. What did we do today? We swept equal highs. What are we going now? We're going down. Simple as that. Also, what I was talking about is daily chart. Let's go to some other pairs so you can see. So you can use these levels as a magnet for the price. Sometimes when the price likes to reverse, for example here, this is perfect example. You mark previous day high, you mark previous day low. What did the price do? Open, went down, took this low, and then went up. So you have to mark these levels so you can see where the price is gonna tend to go, because there are liquidity levels on this area. One more thing, whenever you have highs and lows stacked on top of each other, the price will come back down to take all this shit. If you have an area and then you have a demand here, demand zone respected, then you have another demand zone respected, then you have another demand zone respected. For you this is positive because you think like, oh, we're respecting demand zones, we're gonna go up, and it might happen short term, but long term these areas are just called liquidity engineering. So the market is engineering all this liquidity so it can come back down and take all of that shit. I'm gonna show you actually one example on gold that I remember. Oh yeah, here. This is actually where I had loss last week. Look at all this area. So we are respecting this shit. Then we are respecting this shit. Then we are respecting this demand zone. Then we are respecting this demand zone. Look how much engineered liquidity there is. So the price went up, took this liquidity, and I was sure that we're gonna go down and take that. But unfortunately what happened is that we reacted off of demand zone, we pushed up higher. I took a loss here, somewhere there, I don't remember. And then we pushed up, but what happened after that? We came back and we took all this area, as I said, this has to be taken. it always has to be taken because this is called engineered liquidity. The market did this on purpose. It engineered so much liquidity here, went up, induced all the people. Now everybody's long, and then now we're gonna go down, take all this shit. And what happened now? Now we can go high. And if you trade, this will happen all the time. Right before the big move, the market will do something to completely fuck you up, to completely mentally tire you, how do you say it, and it will shoot in the other way. So every time that you have perfectly higher highs and higher lows stacked on top of each other or whatever, something like this, you have to understand that people are putting their stop losses above these areas here. So the market will eventually come back, it will run all this shit, and then it will go back down. So yeah, that's it for today. I'm sorry guys, this video is not very good organized, but as I said, there's not so many people watching it anyway, so in case I get some following, I'm gonna start making a little better content. But I'm sure if you watch this video, you're gonna learn something. If you have any questions, please ask me in the comments. Gold here looks like possible short, so I'm gonna look what's happening. If you have any questions, please let me know in the comments. I'm gonna reply, subscribe or whatever, and enjoy your life. See you in the next video.